What the hell are bonds, actually? That is what we're discussing in this video. This is day 3 of 100 Days of Finance, where the entire goal is to give you more personal finance education in 100 days than most people receive in their lifetime. As always, my name is Derek, and I got my degree in finance, so you don't have to. Let's get right into the video. So, what are bonds? Well, bonds are a type of fixed income investment. Basically, they are loans made by you, the investor, to the issuer, which is the entity that created the bond. Usually, these are governments and corporations. Now, you are basically lending the issuer money. Then they pay interest to you over a set period of time. Not only that, at the end of the set period, you get your initial investment back. Now, there are different types of bonds. Government bonds, which when you hear about bonds, you are probably hearing about these. There are also corporate bonds, which, like the name suggests, are issued by companies. There are also high-yield bonds, better known as junk bonds. These are basically very risky bonds, issued by companies with credit ratings. But hey, on the bright side, they usually promise very high returns. That's if the company isn't bankrupt by the time it owes you money. Now, government bonds are the least risky. And when most people talk about bonds being less risky than stocks, they usually mean government bonds. That's because, in simple terms, the US government and other countries' governments have a very low chance of disappearing. And for example, in the case of US Treasury Bonds, the government has never not paid on time. Now let's talk about you getting paid. This is what's known as the yield, which is basically the interest rate on the bond, kind of, but not really. You see, the yield stays the same, always, but the interest rate can change depending on the price of the bond. Let me give you an example. When a bond is issued, let's say for $100, the yield is set. In this example, let's say $4 per year. That's a 4% return. But in the case of government bonds, if the federal funds rate changes, yes, I have a video on that coming. Basically, this is what they mean when you hear on the news that interest rates are rising. Anyways, when the federal funds rate rises, the price of already issued bonds fall. This is because the new bond will be issued with the higher yield to compensate for the higher interest rates. This means the price on old bonds must come down to compensate. If you have a $100 bond with a $4 yield, but the interest rate rises to 8%, the only way for that bond to pay out 8% is for the price to fall to $50. Don't worry, that's only if you sell early though. If you wait until the agreed upon time, you will get your full $100 back. This agreed upon end date is what's known as the maturity date. Okay, so what are the risks of bonds? Well, bonds are considerably less risky than stocks, but there is still risk. For one, inflation. This erodes the purchasing power of your interest payments. And if the inflation rate is higher than the yield, well, then you just locked up your money for no reason, and your $100 investment plus interest will actually be worth less than the initial $100 investment. So there are risks, but generally bonds, especially government bonds, are one of the least risky assets because you will almost always get your initial investment back plus a little extra. Now, in tomorrow's video, we are going to be discussing what exchange-traded funds are, also known as ETFs, as we continue our journey of 100 days of finance. So make sure to subscribe and turn the bell notification on so you don't miss the 100 videos of financial education. I hope this video was easy to watch and very informative. The whole goal of this 100 days of finance series is to give you more personal finance education than 99% of people receive in their entire life. Again, my name is Derek and I got my degree in finance, so you don't have to. I love this stuff. It's been my passion for over a decade, and I love being able to share that with you. Can't wait to see you in tomorrow's video.